So now I want to show you an analysis that can be very helpful in this regard. So I'm going to, Natalie, I'm going to take yours down, hopefully, and pull mine up. Yep, there we go. Here we go. So this is called marginal cash analysis. And not very few companies do this type of analysis, but it can be extremely helpful. So we're going to use the same numbers that we used before, that same company that we did the Z-score calculation, same numbers, to calculate what's called marginal cash flow. So we start off and we're going to normalize all of these numbers on the income statement and balance sheet. We're going to normalize to $100 of revenue, $100 of revenue. So as we saw before for this company, for every $100 of revenue, they have costs of sales of $46.70. We saw that when we calculated the ratios. So their gross profit margin is 53.3. So for every $100 of revenue, they've got just over $53 in gross profit. Then we look at what's referred to as their working capital, starting with accounts receivable. And with some quick math, we find that for every $100 of revenue, they add $10 in accounts receivable. And all we did was just divide their accounts receivable by on their balance sheet by the revenue on the income statement. So for every $100 of revenue, they have $10 in accounts receivable. For every $100 of revenue, they add $5 of inventory. For every $100 of revenue, they also have $7 in additional accounts payable. That shows up as a -7 because that's money that we owe to our vendors.
What page is that on? Did I miss that somewhere?
Nope, it's not on a page. This is just new information. So we add those up. We add the 10 plus the 5 minus the 7, and we get $8 in working capital. For every $100 of revenue, we add $8, or we need $8 in working capital. Okay, again, using the same numbers that we used to calculate the Z-score, the income statement and balance sheet. So we subtract the $8 in working capital from the gross profit of $53.30, and we get what's called marginal cash flow of $45.30. For every $100 of revenue, we're left with $45.30 in marginal cash flow. The final calculation is we now have to account for our operating expenses. And we saw before that for every $100 of revenue, we have $48.70 in operating expenses. So we subtract that operating expenses from the marginal cash flow of $45.30. And what we end up with is what's referred to as net variable cash flow of $3.40, negative $3.40. So for every $100 of revenue, this company has negative cash flow of $3.40. So number one, I want to make sure everyone understands the math, how we arrived at negative $3.40. Everybody see how we got that? Okay. So what does that mean? What this means is that for every $100 worth of incremental revenue, if I go out tomorrow, if this is my company, if I go out tomorrow and make a $100 sale, if I bring in $100 of revenue, the result of that $100 of revenue is going to be negative cash flow of $3.40. Now that may seem strange. It's like, well, how can you have a sale that ends up with negative cash flow? The reality is that many companies, particularly many small companies, have negative cash flow. It's not that unusual. My guess is a number of your companies have negative net variable cash flow. And it's not necessarily a bad thing. It's only bad if you don't know that you're running negative cash flow. Because if you don't know this, you're at risk of running out of cash.
Tim,
Yeah,
in your example here of marginal cash analysis, assuming there's an increase of over $100 in revenue, operating expenses may or may not increase depending on the business model.
you're right.
If
I'm not taking into consideration any economies of scale, any efficiencies. I'm just assuming that the model stays exactly the same as we grow.
Okay.
And yet, as we grow the business, very likely we may be able to reduce our operating expenses. We may be able to improve our gross profit margin. But the assumption that we're making here is that everything is going to stay static, just for simplicity. Thank you. You're right. Yeah.